Welcome back. It's your boy GTS with another YouTube, but I want to do something a little bit different this time. I want to do a mini series on mastering the mindset of a trader. And this is the most important part of trading. In actual fact, it is the most important part of participating in the financial markets, whether that's buying stocks and shares, whether that's doing swing trading, day trading, whether that's doing options, because the mind is going to be your best friend or your enemy. And the emotions of humans, we have like anger, happiness, greed, all these emotions. We need to kind of park them at the door and try and be objective of things, right? And look, I know it's easier said than done, and I don't want to go too guru or philosophical. So what I'm going to try and do in this series is break down an emotion and relate it practically to trading, right? So what we want to try and do is give examples of how you can avoid the pitfalls and become a better trader by mastering the mind. Because when push comes to shove, it doesn't matter how good you are at drawing lines on a chart, it doesn't matter how much you've read about a company. If you can't control this, then all of that stuff doesn't matter. It actually doesn't matter, right? And most of the time, this will only make sense after experience, okay? So after years or making the mistakes, those penny drop moments. But I can only try and give over what I've experienced because I've been there, I've been through the motions, and even to this day, as any seasoned trader would tell you, you still have to keep a lid on things and constantly keep a check on your emotions. And there is a way to do it, which I'll be dropping at the end of this video. There's a way to keep a check on these things, but let us not waste any more time and get straight into it. So, episode 1 of Mastering the Mindset of a Trader is going to be all about greed. Greed. Now, greed is an emotion which some may argue it is probably what gets a lot of people into trading investing because it's that lust for more money, quick money. And that is where they are mistaken because that lust for quick money is where greed kicks in. And that is the avenue that takes us to the wrong mindset of a trader because greed is not going to help you. You have to be hungry. You have to have that hunger, of course. I'm not going to sit here and say you can't be hungry, but you also have to tame that hunger, right? You have to know when to strike, when to act in a certain way. One of the things that greed does to us is FOMO, fear of missing out. FOMO. And we get FOMO with a lot of things. FOMO is when your friends are all going out, you know you shouldn't, but you think you're going to miss out on something great. And most of the time, it's not a great night because it'll be the same as any other night, but you still decide to go out. FOMO is that feeling of missing out on something, but it can be irrational because most of the times we're not missing out, right? So FOMO is a big thing. And how does that actually relate to trading? Because I did say, and I made a promise that I would have practical advice. So FOMO kind of goes hand in hand with patience, right? And what I mean by that is, let's say you have a trade, okay? You want to take. You have an entry, you've done your homework, you've drawn your lines, you've looked at your technical analysis, whatever it may be, you've done your homework, okay? You've ticked all the boxes. Now you need to enter, okay? But let's say you have a range for entry or an entry point and it misses, it doesn't quite get there. What happens is, because we've put that work in, we have a thing called sunk cost fallacy. We believe just because we put the time in, there's some value to it. And so what we might do is we won't exercise patience, fear of missing out kicks in, that greed. And then what we do is we get a bad entry or we don't wait for a good entry. And what can also happen is we might enter at a bad entry through greed, then it comes to a good entry, then we enter even heavily, and let's say on this particular trade it doesn't go your way. Now you've over-entered, you're over-leveraged, you're using too much of your account on this particular trade, you're risking too much. What's going to happen with that? More emotions are going to kick in, right? So it's very important that fear of missing out and being patient is exercised. And a way to do that is having risk management. And risk management isn't just only risking what you can afford or using appropriate equity or margin on your trade, but it's also about really sticking to things like if I miss my entry or if I only hit the top end of my entry zone, then I will only put on a small amount, right? And sticking to that. And even if the trade goes your own way, you don't want to sit there and say, oh, I should have, because that word or those words should have is what leads to more greed in the future, because you're putting more weight on the should have when you should be putting more weight on you done your homework, you still entered the trade, you made money, that ticks all the boxes. And again, this is greed, right? That fear of missing out even after the fact. And that is where you must exercise patience and stick to risk management, which just isn't your margin or the amount you risk, but it's also having a plan of how you plan to enter, right? It's having a strategy on how you plan to enter. So that is the patience part, right? But then let's say we're in the trade, and this is another aspect of greed. So this is before we got into the trade. That was the part we just spoke of. Now we're speaking about once we are in the trade, right? And what does that involve? Well, that involves a thing called framing and loss aversion. So we enter a trade. Heck, we have a range, okay? And in that range, we maybe have 6 trades on, okay? And we've got these 6 trades running, and we hit your first take profit target, okay? Now, if you think about it, you're now closer to your second take profit target than you are your stop loss, right? You went from here to your take profit 1, and your stop loss is here. You're now closer to your take profit 2. But for some reason, most people want to not wait for take profit 2, even though you're much closer to it now. You've done all the work, you've put in the effort, you've executed the trade, you're now closer to take profit 2. They want to cash out early, so they're not adding to their winners. Or in another way is staying, or another way to think about it is staying in their winning trades, right? And moving their stop loss up. And even, let's say you're up $1,000 on a trade, right? You can move your stop loss up so that your remaining positions cash out minus 1,000, so that your balance is 0. You leave the trade with not a loss or not a win. Now you might think, like, why would I want to do that? Because sometimes you have to give the markets a bit of leeway to allow it to move, right? Because it might hit your first take profit, pull back a little bit, then go to your take profit 2 and take profit 3. So how do you give it that leeway? It's accepting that a position is also break even. Break even's a position. Break even is better than a loss, right? So the same way that we will not wait for take profit 2 or take profit 3, even though we are closer to it now, right? When we enter a trade and it's not going quite our way, so it's a bad trade, losing trade, right? What we have a tendency to do is loss aversion. What is that? That is where we're kind of framing things in a way where we're like, oh, well, if I just add more into this, I'll be able to recoup my loss. So we actually do the opposite of what we do with a winning trade. So with a winning trade, we don't wait to hit our take profit 2 or take profit 3 or add to a winning trade, right? We do the opposite with a losing trade. We add to it because the wanting to not have a loss is felt so heavily that we will add to it, meaning we in actual fact lose even more. So there's 2 sides of the coin. So it's not having the patience to wait out for our take profits when we've done all the work, but then we seem to have the patience to want to wait and accumulate more of a loss when you know you should just take that one on the chin, because the inevitability is that you can't win everything, right? But you can have a high success or win rate, but not everything. So that is where you're mastering that greed aspect, because you want to put that at the door, accept that if a trade's not going your way, it's not going your way, and there'll be another trade in the future. And that's where patience comes in. Because like I said, patience and greed will go hand in hand. And being patient and waiting, because the markets aren't going anywhere and there will be more setups, more trades, more ideas, is a better position than simply flinging everything out during a trade and getting too excited and too happy and allowing, greed to take over and not accepting a loss. So that is where you need to balance those things. And with that all being said, how do we practically sort of manage this? Because at the start I said I would drop a hint on how we can actually do this. And well, the thing is that journaling. And I remember when I first was on my journey of the financial markets, I didn't journal. And now I journal everything. Why? Well, let me tell you why. Because see, when you have a share purchase, you've bought a company of a stock, or a trade doesn't go your way, right? What do we all do? We'll all sit there and say, oh, I shouldn't have done this or I shouldn't have done that. And then you'll say it again. Just saying it doesn't mean you will remember it, right? You think by simply saying, oh, I shouldn't have done that means that you will learn? No, right? Because what you'll find is you'll probably keep saying that over and over again, each time not remembering, not learning your lesson, whilst actually writing something down is helping to slowly program it into your memory. And that's what it's about. It's about being robotic, following a system. What did I say about risk management? It's about having a system in place and sticking to it. Not necessarily about the amount that you're risking, but about sticking to the system. That is part of risk management. So journaling will help you do that, right? So get a journal, write down everything that goes well, that doesn't go well. Be patient. Patient means that sometimes missing things and waiting for another opportunity. Being patient also means that when something's going your way, allowing it to keep running your way. And patience also means that if something's not going your way, then not allowing greed to kick in by adding more to it in the hopes of recouping losses. And that is a quick nutshell wisdom drop for being in the markets for 10, 15 years on how to master the motion of greed when it comes to the financial markets and trading. And that is me out. For the next episode, there'll be another emotion. We'll have more practical advice, and I will see you there. Let's go, GTS.